a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Well, if you wanted to know about dividend growth ETFs, you've certainly come to the right place, because our ETF research director, Nina Mishra, is here now to tell us a little bit more about those types of ETFs. First of all, as far as the market goes, lately it's all about Greece and China.
Yes, all about Greece and China. You know, events in these countries led to a widespread sell-off in stocks and a small rally in so-called safe haven assets.
Yeah.
And today there is a little rebound after the recovery in China. But I believe in the shorter term, volatility is going to stay at an elevated level.
And today's the 9th of July for those people following on the calendar.
Yes, but investors should focus on the longer term picture.
Okay.
Especially events in Greece, or Greece for that matter, does not matter a lot, will not have a significant impact on global financial markets. China is a little more worrisome. If the route there resumes, then we will probably see some spillover into the US markets as well. Now, here in the US, the economy has been gradually improving, although the very recent economic data has been mixed, pointing to a not so hot, not so cold economy. But the Fed appears to be on track to start raising interest rates. And if the economy perks up in the coming months, then we may see a hike later this year or early next year. So investors should start positioning their portfolios for the rising rate environment. So
against that backdrop, dividend stocks and ETFs have been very popular with investors. Yes,
because of the rock bottom interest rate scenario, interest rate environment, people have been putting a lot of money in these dividend stocks and ETFs. Now, in view of the rising rate scenario, investors should look at their dividend ETFs and stocks and try to position them according to the changing market dynamics. So they should remember that ETFs that focus on high yield stocks, high yield ETF, dividend ETFs, they usually have a lot of exposure to defensive sectors like utilities and telecom, because these sectors traditionally have high payout ratios. And these sectors tend to underperform in the rising rate scenario. So I prefer ETFs that focus on dividend growth stocks, stocks that have been growing their dividends. These are usually high quality companies, and most of these ETFs, they have more exposure to cyclical sectors, which tend to do well in an improving economy and hold up better during a rising rate scenario. And further, US companies have a lot of cash. Most US companies have a lot of cash.
Still on hand, yeah.
So dividends, they have been growing their dividends, and that trend is likely to continue. And lastly, history also shows that dividend growth stocks have outperformed high yield stocks over longer term, and they also, hold up well. They weather market volatility better, and they perform relatively better during market downturns as well.
That's interesting too. All right, as you always do, you've brought a couple of examples of these types of ETFs to talk about. First being Vanguard Dividend Appreciation ETF, VIG, the ticker.
Yeah, this is the most popular ETF in the dividend ETF space. It has almost 20 billion in assets under management. It tracks high quality companies. It holds, I think, about 160 to 170 companies as of now. And these companies have been raising their dividends for at least last 10 consecutive years. It charges an expense ratio of just 10 basis points. It's an ultra cheap ETF, so it's an ideal investment for longer term focused investors. Microsoft, J&J, and IBM are among the top 3 holdings. In terms of sector exposure, it has high exposure to consumer, followed by industrials and technology sectors.
Okay, and then ProShares has the ProShares S&P 500 Aristocrats ETF. NOBL is the ticker. That's appropriate.
Yes, and these are the companies, again, high quality companies, which have been raising dividends for the last at least 25 years. It's an equal weighted ETF. It holds 25 companies and almost equal weights. Slightly higher expense ratio of 35 basis points, but still reasonable. This is also a Zacks Rank 2 buy rated ETF. This also has highest exposure to consumer, followed by industrials and financial sectors.
All right. Do you own either of these two?
I don't.
All right. Check out more information on ETFs in the ETF section of our website, Zacks.com. Just go to the home page, and you can link to the ETF section using the Funds tab in the top toolbar. Don't forget also, you can follow us on Twitter, and if you're watching our videos on YouTube, subscribe to them and even comment on them. So you might want to look into that. Meantime, with Nina, I'm Terry Ruffalo.